the gold price is at all-time highs. The opportunity for specific sectors in the juniors, I think, is particularly compelling right now and irresistible.
Gold at $2,500 dramatically transforms the mining industry from top to bottom. And at these gold prices, companies could be 10-baggers or better, yet it seems like nobody is noticing, says today's guest, Brien Lundin. With 40 years of experience in the mining industry, not only as an editor of the Gold newsletter, but also as the producer of the New Orleans Investment Conference, Brien's words should not be taken lightly. And that's why I'm especially grateful today to have him on the show of all days, as we stand on what I believe is the precipice of a generational investment opportunity here with junior gold miners. Brien, thanks for coming on the show.
Great to be with you, Ted. Thank you so much for the opportunity.
Oh, the pleasure is all mine. So before we get stuck into the juniors, Brien, I do want to talk a bit about the context, the wider context as to why gold. I think it arguably matters today more than it ever has before in history, perhaps, certainly in modern history. So I was thinking you could start by answering that question in a mathematical way in respect to US government's unsustainable debt trajectory, as I know that's something you're very well versed in. And then after that, it'd be good if you kind of give the historical standpoint on why gold matters, and then also geopolitically with regard to the escalating conflicts in the Middle East and Ukraine.
Yeah, that's a lot to start off. We could talk for a few hours on that.
Yeah.
You know, the why gold, there's a couple of different ways to go at it. And I tell people who are new to the sector, there's two reasons to invest in gold, as insurance and as an investment. As insurance, you know, over broad sweeps of time, gold always has protected savers, investors, people against the depreciation of their currency, the depreciation of the purchasing power of their currencies. And we can see that over time in the US, for example, the cost of an Ivy League education, if valued in terms of gold, is the same today as it was in the 1930s. The Dow Jones Industrial Average, the S&P 500 have barely budged over 60 years if you price them in gold. So, you know, gold keeps up, preserves your purchasing power. So that's the insurance part of it. The investment part comes in when you look at the macro picture and see if it argues for one of these catch-up periods for gold, where gold has not really kept up with the depreciation of a currency or inflation. But then people start to really get concerned about what's going to happen. So gold really accelerates to the upside in terms of its value in these depreciating fiat currencies because people are becoming more concerned. And I think all evidence points to us being in one of those periods. In other words, the period where you would want to invest in gold. The primary, as you alluded to, argument that I make for us being in one of those periods is the fact that after 40 some odd years, about 4.5 decades actually, of ever easier money, of interest rates always being ratcheted down in response to slowdowns in the economy, but never being brought back up to where they started. And eventually, after the 2008 great financial crisis, quantitative easing, a lot of direct programs to rescue the economy, fiscal easing, and then post-COVID, even more extraordinary efforts. We see this very clear trend of ever easier money, and it seems like we're in the end game of that trend. And over that period, those ever lower interest rates, that period of ever easier money, encouraged the accumulation of ever greater debt loads, to the point now where in the U.S., the federal debt demands over $1 trillion in debt service payments and rising at current interest rates. So what this entails, when you have a debt load that's this great, it means that your currency has to depreciate at a faster rate than you're paying interest on that debt. That means that interest rates have to be below the rate of inflation. You have to keep inflating that debt away at an ever greater rate, in other words. So you have to have negative real interest rates going forward, regardless of the fact whether we're going to come to some sort of a great reckoning or reset because of these debt loads. We are still going to be forced to have negative real rates, generally speaking, as the background economic environment going forward. And that's incredibly bullish for precious metals, the monetary metals, really all commodities, tangible assets, and it's bearish for a lot of the financial assets that we've grown, the markets have grown more accustomed to over the past couple of decades. So there's really a huge shift now toward more tangible assets, and in particular, I think the monetary metals.
Real quick break here, guys. If you are a mining investor, you are without question familiar with the Golden Triangle region in British Columbia. This is one of the most prolific mining regions in the world due to its vast deposits of gold, silver, and copper. Now, for the last 4 years, Dolly Varden Silver has been busy expanding their high-grade silver deposit in the Triangle, and they are backed by some of the smartest investors in the silver business, including the legendary Eric Sprott, Hecla Mining, US Global Investors, Fidelity, Delbrook Capital, Sprott Resource Corp, and more. If you are curious why the smartest money in the silver business is cozying up to Dolly Varden Silver, then hit the link beneath this video.
One of the parallels as well that I've noticed with history is this financing of war efforts tends to be the sort of sign that an empire is coming to an end. Obviously, that's happening today with the Ukraine, and perhaps that's providing a geopolitical premium to the gold price. What's your current take of the current conflicts globally? Do you think they are in a position where they escalate? And do you think it matters, or do you think the main thing is that, like you say, the mathematical unsustainability of government debt spending?
Yeah, I think the monetary issues always outweigh and overwhelm, frankly, the geopolitical issues. There's no rational reason why investors around the world and savers around the world should flock to gold and buy gold because of some kind of a dust up in the Middle East, yet another dust up in the Middle East, or some other little geopolitical hotspot around the world. It's concerning, but it's not global in nature. And the real reason to buy gold is, again, it's because your currency is depreciating, and you fear for the fact that it's going to depreciate at a much quicker rate in the near future. That's why people buy gold. Now, all that said, you look at the parallels of great empires, and the analogy between the U.S. and Rome is trite. Everybody says it, everybody talks about it, but that's because it's so real and obvious. I mean, Rome was crushed by really the same issues we're facing today. Overspending on, military campaigns, bloated government, entitlements. People don't realize the entitlement spending in ancient Rome was crushing their federal budget. So there are very clear parallels between the U.S. and Rome. And, that said, we can take some comfort in that it took a few centuries for Rome to collapse. So we may have time on our side, but the trends, the timing is always the tough thing. The trends, though, are clear, and we are trending toward a situation where we're going to see not just the U.S. dollar, but all fiat currencies depreciate much more quickly than they have in the past. And that's why I think gold is going to rise again to be the premier asset for both insurance and investment.
Mm. Yeah, no, I would completely agree, Brien. And I guess that brings us to the next point that I want to talk about, which is, of course, gold juniors. I think you state on your website, beyond its role as insurance, there are ways that you can leverage the inevitable increase in gold prices to build your wealth. So, of course, you're talking about, I think, mining companies, producers, developers, also juniors, which, of course, specifically juniors have the potential to rise hundreds of % in value, sometimes within a few days, depending on the news that moves the stock. But then some investors within our community, Brien, they still kind of have this view that if you can't hold it, you don't own it. In other words, they're only interested in the physical, not the companies who mine it. So whilst everyone's entitled to their own investment approach. What would you say to this category of investor if they said to you, Brien, I already own some physical, why should I invest in the gold juniors?
Well, it gets back to what I said, insurance and investment. I certainly won't criticize anyone for buying gold and silver to ensure their wealth. And I recommend that as the first step for anybody entering the sector. But there is that opportunity, and we've seen it happen before. I've been through a few cycles in the junior mining market. Most recently, and most, I guess, compellingly, was the early 2000s, where you had companies that would typically go up. I mean, a good company, good prospect in a favored sector with good management, if you got in early, they were generally good for a triple or more on their share price. And the key, of course, was finding companies that fit those criteria. But along with that, you had a lot of 10 baggers, 20 baggers, and the like. The downside was quite often, instead of losing 80% of your investment, as we've experienced over the last 5 years or so, the downside was maybe just holding even on an investment. So that really quite dramatically alters the performance of a portfolio when your downside is protected by a rising tide lifting all ships, and you have the outperformance on the upside. So I think we're facing a generational opportunity like that.
Yeah.
Again, it's like 2000, except for the fact that gold is not at an all-time low. The mining stocks are, but the gold price is at all-time highs, nominally getting close to getting that way on an inflation-adjusted basis. So the opportunity for specific sectors in the juniors, I think, is particularly compelling right now and irresistible. And you can buy metal cheaply in the ground with companies that have really large resources already established.
I absolutely agree, Brien. And I think, if we bring it back to the present day, probably the case for investing in gold juniors is better than it's ever been, certainly in my lifetime, but maybe in yours too. I mean, if you look at the last 12 months, the gold price has achieved an impressive return of 28%. And in the same period, GDX has returned about 31%, GDXJ close behind with a 26% return. And when we look at the technicals as well, GDXJ, according to Tavi Costa, is officially now in a breakout territory and would need to quadruple to reach the all-time highs that it set way back in 2010. And then also, when you look at the fundamentals as well, like the Fed rate cut in September, the Q2 cash flows already in the pipeline. I think we saw Agnico Eagle just earlier a few weeks ago record free cash flows, stock price at all-time highs. So this is really the burning question, Brien. Do you believe we're on a brink of a period of serious outperformance in GDXJ? And do you think this could be the last chance to load up on junior miners before we really take off?
Yeah, I do. Now, I have to admit that I've said that for a while now. And the window, it seems to be closing, but it has not closed yet. There is still huge opportunity there, and I think it still is a huge opportunity. I don't think the generalist investors that we often talk about, in almost mythological terms, are they going to come into the market, and when are they going to come into the market? I don't think they can ignore the cash flows that these major miners are producing, because while we saw over the previous year and a half or so inflation drive up operating costs and capex costs for miners, over the last 2 quarters, the gold price has risen far more quickly than costs have, and especially energy costs, which is obviously the huge component of OPEX for miners. So we've seen these margins just expand, even explode, and I don't think the generalist investors can ignore that much longer. And I think we will start seeing them go further down the food chain into the juniors. And in that respect, one of the big opportunities I see right now are these companies that used to be optionality plays. In other words, they went and acquired really large gold resources that were out of the money at current gold prices, trying to play on that leverage that as the gold price rose and all of a sudden these projects would become economic, you'd have a very dramatic increase in the value of the projects and the value of the companies. Well, lo and behold, over the last quarter or so, just about every one of those out of the money plays has become suddenly in the money. And they can't reflect that in their pitch decks or anything else because the gold price has risen so quickly that even their extrapolated, projected sensitivity to the gold price, those tables that they put, at this gold price, our NPV and IRR increased to this level. None of those tables go past $2,100 gold, much less $2,500 gold. So that's why, I say that the industry has been completely transformed, but nobody's really recognizing it yet. These companies can't even officially report. The regulatory agencies won't allow them to show what their projects will do at $2,500. But all of those out of the money plays, they're in the money now. And some of them are actually financeable and achievable or will be very soon. And their share prices don't reflect that new reality at all.
That's really interesting. And you talk about the generalist investor there, Brien, as well. I think one of the things that has been difficult for the mining companies is not necessarily the generalist investor, but the attracting money from the institutions, the financial institutions, convincing the banks and the wealth management companies, the family offices to part with their money and put it into gold miners. Are you seeing any evidence that these free cash flows, and I want you to talk about the Fed rate cut as well, would be the kind of the straw that breaks the camel's back to bring in that investment, to entice it after so many years of it kind of being disincentivized or just uninterested in gold miners?
Yeah, I'm starting to see it, but it's been anecdotal at this point, and I haven't seen hard evidence of shifts or any data that shows hard evidence. But the thing we need to remember is if family offices shift their exposure to gold and miners from say 0 to 0.5%, we're talking about huge inflows into this relatively tiny sector. Compared to the oceans of liquidity that are sloshing around the world from one market to the other, just a ripple in the direction of the gold miners. I mean, we're talking about an entire sector that has a lower combined valuation than most of the tech giants out there. So it doesn't take much to have a really tremendous reaction. And if and when this sector becomes the flavor of the day, if it has just a shade of the AI, theme to it or enthusiasm to it, it's just going to, blow the socks off the entire sector. And that, I think, is where we're trending toward. I don't want to say it's inevitable because I don't want to jinx it. But when you look at the debt loads, when you look at what that entails for fiat currencies, when you look at the valuations in the mining sector and the cash flows that are being turned up or will be turned up, I think that it will have to be recognized at some point. Still in the early stages of that right now.
Yeah, absolutely. So with that in mind, I guess we've covered the why, and it's quite a compelling case for both physical gold and the juniors. But now I want to talk a bit about the how, because I think given the scale of this, what we call a generational opportunity, there are going to be a lot of cowboys out there, whether that's in the physical gold space, conning people, particularly elderly people with IRA scams, and then on the junior side, people claiming ridiculous grades and just enticing people, selling them a dream. So a lot of it obviously comes down to doing your due diligence, whether that's doing the homework on the management, researching the jurisdiction, or analyzing the project economics. But as an analyst myself for David Morgan, one of the things he's mentored me to do is to look at the management's track record, see if they've succeeded in the past with big hits or buyouts. So I think let's start there, Brien. Specifically with regard to management, what are some of the green flags that you like to see? And also, on the other hand, what are the red flags that you like to avoid and run away from when it comes to gold mining investments?
Yeah, you do want management teams that have done it before. I mean,
Yeah.
this is your ideal. If there's an incredible asset, an incredible discovery with an inexperienced management team, you may buy that anyway if you can get in early. But if you had all of your dream scenario, you would want a team that's done it before. You want a team that is more concerned about their reputation than the money that they'll make on a particular deal. So they don't want to be seen by the market as having a failure. So even if that first venture, the first project doesn't work out, they have backup plans. They have the ability to roll other projects in. They have the ability to make it work for their investors. Part of that, obviously, you want them to be invested in line with you, to have a significant reporting shareholding in the company. And that really comes kind of part and parcel of a good management team, because they always will, if they are good. And, the projects are part of it as well. You don't want a company that's looking for, a 500,000 ounce deposit that they can bring into production themselves. I mean, that's kind of the classic trap investment in the junior mining sector. There are a number of other things that you can look for, and look not to invest in. A lot of negatives that you want to avoid, a lot of pitfalls. The list is long. We do have a free special report on our website, goldnewsletter.com, called The Investor's Guide to Gold and Silver. And it outlines everything you need to know, from physical to mining stocks to even futures and funds. One of the key points, though, of that special report is that this is a very inefficient market, the junior mining sector. That means you can find values. You can find gems that have been just left overlooked temporarily by the market if you do your homework. If you invest in subscriptions to some of the best newsletters out there, and we do detail all of those. If you go to the best conferences out there, spend a little money, spend some time, meet management teams, find those undiscovered opportunities, look management in the face, talk to them, ask them your questions, get their plan Bs. But generally speaking, spend the money, the skull sweat, outwork other people, and you can not only maximize your returns, but outperform other people who aren't willing to do that. That said, if you're not willing to do that in the junior sector, then you're going to expose yourself to all of the classic risks in this very risky sector. So then don't do it if you're not going to put in the work. Just invest in the indices and you'll do fine. I mean, in a typical gold and silver bull market, the GDX and the GDXJ will go up maybe 4 times, maybe 5 times in value over the course of that bull market. That's great. You won't expose yourself to a lot of the really tremendous winners that you can get in the junior sector if you don't do your homework. But you really have to be willing to do that, because it is a risky sector. There's the rewards are commensurate with the risks.
Yeah, that's absolutely true. I think the quality of information that you get from your newsletter, the Morgan Report as well, allows you to be informed and better informed about these decisions. Okay, so you kind of cover management there as well, Brien. I do want to talk a bit about the jurisdiction. I assume there are things about Fiji that you admire as a jurisdiction, given that's where your company Thunderstruck Resources is based. And I would also assume, like most people, you like Golden Triangle in BC, where great operators like Tudor Gold are based. So in terms of do you have a list of your favorite jurisdictions, and do you have ones that you avoid, perhaps in Africa or, maybe South America? Are there any emerging jurisdictions that you like? I mean, I certainly like Argentina at the moment.
Yeah, Argentina's come along. Argentina has always been, it's not just Argentina, it's which province are you in? So you do have to look into that. I don't have a list, and generally speaking, I don't really invest in the junior sector thematically. I don't say I'm going for these, I'm going for those. I can recognize, like, these optionality plays represent an opportunity right now, but I also can't resist, quite frankly, the really sexy discovery play or a drill hole play. I've had many of those successes in my career, and those are just a lot of fun when they work, when it all comes together. But obviously, they are riskier as well. Now, I look at these companies individually. Each has a story, and it's a story business. That's what really makes it work. So you have to look at each story, look at the management team, look at where they're operating. 2 years ago, the risk in Mexico was, I think, over-exaggerated. Now I don't think the risk in Mexico is over-exaggerated. I think it's scary relative to where it was a couple of years ago. But a great company like Vizsla Silver, for example, I think that's a huge opportunity that will weather whatever storms come that way. So you have to look at the project in relation to the sovereign risk. And you also have to recognize that usually when you invest in a junior mining company, your projected time scale of that investment is 2 or 3 years or so. So all of these frontier regimes in the junior mining sector, they come into vogue and then they get out of vogue as governments change and get restrictive. You see if metals prices soar and mining companies are making a lot of money, then governments will come in and renegotiate deals or seize projects, nationalize projects. These are cycles that seem to repeat over and over again. But if you can take that long time frame of history that's replete with risk, and you just want to take a little 2 or 3 year segment out of it, that your investment just has to hold together for that long to realize a discovery success or development success, it mitigates that risk considerably. And also diversification. You don't want to put all of your eggs in, one basket in terms of investing your entire junior portfolio in one company, or even just 2 or 3 companies, or one country, or one asset, or one sector. So diversification is key, but also not having too many companies that you can't keep track of them either.
Yeah, I think that's is it Stanley Druckenmiller or someone within the financial advice community talks the opposite of what Warren Buffett advocates for. Like, instead of being overly diversified, just have like a few stocks. It might be Peter Ackman. No, Bill Ackman, that's his name. Yeah. So you mentioned Mexico there. That's quite an interesting one. So we've got this kind of pro-environmental president who's come in. It seems like she's banned open pit mining for the projects in the future. Are there any other countries, for example, I mentioned Africa specifically. Are there certain countries within Africa that you just wouldn't bother with because you just think it's corruption or too many risks?
Yeah, there are some that, if you look at West Africa, I think Ghana is safer than most of its neighbors. Namibia is a fairly safe country has been somewhat unrecognized. There's a new frontier opening up in Liberia that people aren't really aware of. And then you get into East Africa, you have to look at some of these countries that have had troubles and represent pretty great political risk, but are also geologically so well endowed, like Eritrea, Ethiopia, and the like, where there is tremendous potential. And that's one of those areas where you look at the project and the team and see if the potential reward is commensurate with the risk. And of course, there's usually a risk discount applied, so those investments are somewhat cheaper as well.
One of them, I guess, enter at your own risk, isn't it? But yeah,
always.
I think okay, so we'll move on from jurisdiction there. I think we've got some good coverage. I want to talk about the part of mining which really matters, which is the geology now. I mean, I'm quite early in my career, as you know, but I've already seen companies wax lyrical about bonanza grade or generational deposits, and some of them are right. But in my experience, these claims kind of turn out to be at least exaggerations of the truth, for the most part. So, what advice do you have for separating fact from fiction when it comes to analyzing a mining company's geological prospects?
Well, read a lot of news releases. And one thing you can do is go to company websites and look at their past news releases. I mean, you can go back 2, 3, 4 years if the company has been around that long, and look at their news releases and see if what they're projecting, or they're regulatorily, they are prohibited from forward-looking statements and making a lot of claims in the news releases. But you can get the gist of what they think and what they're saying, and see how these things turned out. See if the subsequent developments lived up to the way they described the projects years ago. But also just learn how to read a news release. That's very important. You need to know what are good grades and what are good grades in what kinds of geological environments. A high grade is great. You can go deep for a high grade, but you typically are not going to get the wide intersections for that. Low grade, a long intersection is fantastic, but how deep is it? And there's so many pitfalls that we can't go into all of them. And I advise you to look at our report that shows how to read a 43-101 report, et cetera. But it's just experience, really. It is experience in learning how to separate what a company says from reality. They are fairly tightly constrained in what they can say in a news release. But any company that is somewhat promotional in a news release, you generally need to run away from, because the facts should speak for themselves. And if it's a really great deposit, a really great project, then the grades and the information, the data will bear that out without having to be fluffed up in any way.
Yeah. I guess that's essentially what comes across, not in all cases, but that desperation of, we've got this bonanza grade. It's because they're maybe overcompensating for the fact that there are, genuine risks with the project, but not in all cases. So that's why you have to do your due diligence, like you say. So in terms of finishing off on the How Gold juniors, I wanted to kind of look into the financial metrics that you look into. So in my experience, the traditional value investment metrics that Buffett uses, like PE ratios, for example, aren't really the best barometer for valuing mining companies. So from what I've learned, I look at the liquidity and the solvency ratios first, and then I kind of move to consider metrics like all-in sustaining cost, EV, free cash flow, PNAV, those kind of ones. Do you approve of those metrics, and which metrics would you recommend I add to improve the quality of my analysis for someone who's an analyst?
Well, the relevance of those metrics depends on where you are in the food chain, essentially in the mining sector, whether you're exploration, development, you have a project, you have economics on it, or whether you're in production. But one of the, my good friend Doug Casey is famous for saying these junior mining stocks are burning matches. They don't make money, they use money. And if they don't have success, they have to get ever more money at cheaper prices. So you need to be aware of the dilution factor. What will a company have to do to get to the next important stage in its either discovery phase or development phase? So price to earnings makes no sense when there are no earnings. Net asset value, price or value, enterprise value to net asset value is sometimes interesting, because that implies that a company has some economics on a project. And obviously a feasibility has more relevance than a pre-feasibility, which has much more relevance than a PEA as far as the economics in a project. But metal in the ground, or even the NPV In situ metal value is one thing you throw out that doesn't matter. Net asset value, net present value is important, but junior development companies can sell for tremendous discounts to that. So that doesn't have much of a relation to what their market value should be at this stage. Some other numbers that you can generally use is that a company for an economic resource of some size in a normal market, which we haven't had for a while, might be valued at $100 to $150 an ounce in the ground. Probably even more so now. We're talking about $2,500 gold, although we haven't had any real takeouts since all of this has happened. So there are a lot of companies out there that have economics and or big resources established at decent grades in good operating regimes that are under $10 an ounce in their enterprise value right now, or their market value. That's a target-rich environment right now for those kinds of opportunities. So that, I think, is an opportunity, generally speaking, but you have to look at those kinds of discounts. It's not abnormal in this market to have a company that's trading for less than a tenth of the NPV of its project. That can represent a great value, but it's not necessarily something that's extraordinary or something that speaks badly about the company as far as its market value.
And that's the thing, I guess, when there is that recorrection of perception in these companies that are so undervalued, you're in at a margin of safety and you just ride and you can continue adding to the position or whatever from then on in. We've kind of talked mostly about gold today. Obviously, you write the gold newsletter, so that was always going to be the case. But I think we'd be doing a disservice if we didn't talk about silver. At the time of recording this, silver price has sunk below $28. It's still up around 15% over the last 12 months. And then on the other hand, we've got the Global X Silver Miners ETF up about 18% during the same period. I've written extensively about this, both for the Morgan report and the In Gold We Trust report, about why I believe the silver price is due for a big recorrection and is due for at least a doubling within the next few years. Once ultimately these supply-demand fundamentals incubate into the price. Do you share my conviction? And if so, what would you say to reassure an investor who's perhaps losing their patience with silver and silver miners right now?
I would say that in every monetarily based bull market, in other words, every long-standing gold bull market, silver has outperformed gold. And I think it will again because of its history as money. It is one of the two monetary metals.
Yeah.
And that's the primary reason. I have always been a big believer that the monetary issues overwhelm all of the other aspects of silver. People bring up have always brought up the industrial nature of silver as a positive, but quite often it's a negative, because if there's bad economic data out of China or fears of a recession in the Western world, then analysts and speculators will use that as a stick to beat silver with. It's industrial usage, so they'll sell off silver in any other industrial metal. I think, and I still believe that the monetary issues, monetary factors for silver are the overwhelming ones. That said, I have to recognize that the projections for silver usage in solar panels, next 10 years or so, they're projected to use all of the newly mined silver production. Annual silver production will be taken up just by solar. Now we have these silver-based batteries from Samsung.
Yeah.
That alone, if they achieve their potential, could take up all of the newly mined supply of silver. That's impressive. That's interesting to me, and I recognize that industrial usages at that rate could put a bind on silver. We also have to recognize that 70% of silver production is as a byproduct of other metals. So silver would have to get to $150 or something like that to spur new production from copper and gold mines and the like, And I don't think that is going to be driven primarily by silver's industrial usage. So there's a lot of factors that go into the mix for silver, a lot of nuances, a lot of complications. But to me, the overwhelming factor is that silver's legacy as a monetary metal will have it not only right along with gold, but outperform gold on the upside. We have to also recognize that it will outperform gold on the downside as well. And we've seen that in the kind of topsy-turvy nature of or trend line of the silver price over the past few months.
Yeah, I think you're probably right with that in the sense that I do believe, silver will outperform. I think we found that it outperformed 6 out of the 7 times in gold bull markets since I think 1967. There was one time where gold outperformed. I forget which one it was. But yeah, we're seeing on the fundamental side, China's importing more silver bullion than it ever has. Record silver bullion imports. India, hugely intensive. I'm not sure. I think we need to do a bit of research personally, just to the community on this. The solid state battery for Samsung, this 1 kilogram of silver per car. I'm not sure where it's come from, but I think that there's definitely more silver than there would be for a lithium-ion battery. But there are also, I think it's important to add a bit of, not get too carried away in the sense.
It's very early on that, and it looks very interesting, but we don't have any idea of really how functional that is, what the uptake will be, what the market share will be. It is very much, a what-if scenario at this point.
And then there's the whole question about EVs in general. I mean, I don't want to get too deep into it, but whether there's actually going to be
and solar as well. But and I should make the point that the projections are so compelling that if they only achieve half of what they're projecting, which I think would be a hell of an achievement, if they only get to half of what they're projecting, it'll make a big impact. And you have to cut back these projections so severely. But I don't think it's going to be the overwhelming driver for silver prices, but I think it's getting to the point where it could be somewhat of a factor.
That's interesting. And especially as we approach the Fed rate cut, I think it's a great chart from Peter Grell that we also repurposed for the In Gold We Trust report about silver performing in the rate cut cycles since 2000, achieved like an average of 300%. So you're absolutely right about that monetary aspect. But, I think it's the fact that we're potentially going to go into a recession. It's looking like we're going to go into one. And that might be why people are holding the money back from silver, because it's kind of straddling between the monetary component and the industrial component. But for sure, whichever one comes through, I'm confident that the price will increase, because it has to, because you look at the fundamentals, the supply deficits, 200 million plus ounces every year. We can't keep doing that, can we, Brien?
No, you can't, but there's been supply deficits for many years, but there's a lot of above ground silver, and we've been waiting for the stockpiles to be reduced for many years. It's still, in all, it is, I think it's obviously going to outperform gold. And you alluded to the fact that the Fed rate cuts, the markets over the past month or two have started to price in those rate cuts. Gold rose over 40%, about $800 from trough to peak during the harshest Fed rate hiking campaign really ever seen. And so you would expect it to do much better in a rate cutting environment. So that's what's really going to bring, I think, the generalist investors into the fold. So a recession would accelerate that. And interestingly, we're seeing the U.S. stock market react negatively, bearishly, to indications of a recession. So bad news is starting to become bad news for the risk assets, other risk assets, now that the market has accepted the Fed pivot, which is really interesting. So our gold, as we speak, is really outperforming U.S. equities pretty significantly right now. It's as we speak, it's falling less, but I think that's could be a dramatic new theme in the markets, that gold in particular would perform well if there's a risk of a recession, or a recession comes, because the Fed will be much more aggressive in its monetary easing. But in virtually any scenario, I think gold seems to be, or has a chance to be, the go-to asset for generalist investors.
No, I would absolutely agree, Brien. And you talk about recession. Another thing that is a really good way of indicating whether a recession is coming is Dr. Copper. Always seems to predict them, and it's currently, it was about $5 earlier this year. It's now down to $4, which obviously suggests that a recession is on the horizon. But just with regard to copper, what's your thoughts on that as a metal, and copper miners? I know you probably have a lot of exposure through gold copper deposits, but what's your thoughts on copper?
Yeah, I love copper. I think we are in an interesting period where we have two very strong bull market cases for metals, one for the monetary metals and one for the energy battery metals out there. And again, I look at the projections for EVs with some skepticism, but even if you dial those back 50, 70%, you look at the fact that copper was already on its base case current applications going into a significant supply deficit with no ability for the industry to really respond because of supply constraints and underinvestment and long lead times, et cetera. And then you add some degree of that EV battery metal theme on top of that, and you see that copper is facing probably the steepest demand curve of just about any commodity in recent history, with severe supply constraints and an inability to respond to that. That adds up to a very extraordinary price reaction. And I think in 4 years, we're going to have $8 copper, and that may just be the start. So I think copper is one of those set it and forget it kind of investments. Find a couple of good plays, but it's not, and just put them aside. It's a great value now, and come back and look at them in a few years, and you should be handsomely rewarded and happy with how those investments have performed. But in the junior sector, the copper plays don't typically perform quite as well as the gold plays, because of those long lead times, the necessity typically to bring in a major partner that dilutes your interests, et cetera. And it's not typically as much of a discovery play as you find in the gold sector. But I'm very bullish on copper, and I think the junior market is a great way to play that.
Yeah, and one of the things you touched on, the EV demand, but also the AI demand. And the scale of electricity generation that's going to be needed. What another commodity that plays into the hands of is, of course, uranium. And I was curious to get your thoughts on where we're at in terms of the uranium price right now. I think it's at just under $79 at the time of recording this. What are your thoughts on uranium and uranium miners?
Yeah, it's the irrefutable, irresistible story that we always think is imminent as well, and not necessarily so. But we have seen some reaction and obviously a pullback, but I think the fundamental story is there. You mentioned AI, obviously that works for copper because it's not just the windings in the EV motors for copper, but it's also the electrical grid that essentially has to be rebuilt and virtually replaced. That's going to create huge demands for copper. AI, these data centers need a lot of copper for them, but they need steady state base load power. One of the things that a lot of people don't fully appreciate right now is the impact of SMR, small modular reactors, are going to come on stream as early as 2030. So the idea here is that a small modular reactor can be dedicated to data centers and get them independent of the grid otherwise, but in aggregate create another huge source of demand for uranium. That's a story that's just coming to be recognized for uranium as well.
Across the board, really, in commodities, I guess it's good to have broad-based exposure. I do want to ask you about a commodity that I always ask about towards the end of an interview. It's Bitcoin. What are your thoughts on Bitcoin, Brien? As some people view it as this hard asset, sound money. Some people view it as a shitcoin, to be frank. What are your thoughts?
I'm somewhere in the middle. I don't think anybody knows. I think people are convinced. I think Bitcoin has some parallels with gold. Then probably the most obvious of which to me is the religious fervor of its advocates. It's as much a religion as an investment. And as part of that, if you have a big stake in an investment, you start to evangelize for that and try to get more people in it because it drives up the value of your investment. And a lot of that is going on in Bitcoin. All of this said, my natural skepticism toward it, especially vis-a-vis gold, is tempered somewhat by some really smart people that I know and respect that are big adherents to Bitcoin. My big problem with Bitcoin, primary problem with Bitcoin, is that I didn't buy it 10 years ago, like I should have. And I think that speaks to the nature of Bitcoin as well. People want to. The big thing about Bitcoin is to date has been its performance and the projections for future performance. It's hard to get beyond that. And so if someone didn't invest, then they have a natural emotional barrier to overcome to invest at this point. Whereas the people who did invest want to get more people in. So there's that constant tension between the two. But the bottom line, I don't think anyone really knows what Bitcoin will become. I think it has to get a use case before it can really get to those levels people are projecting. I think the thing to be afraid of is not so much Bitcoin itself, but the entree of governments and central banks into the crypto world with central bank digital currencies. I think that is the scariest thing on the horizon that I see. It's absolutely inevitable at this point.
Yeah, I think that's one of the concerns I have as well, is that Bitcoin is this direct opposition to the centralized control of governments. It is like going straight up against it. But on the sidelines, you have gold and silver, which for me are kind of the neutral monetary assets. They're not a direct opposition. Yes, we're seeing gold-backed currencies being floated in other countries. I mean, that's the last question I have for you. Do you think that we could ever see a gold-backed currency? I mean, they talk about it potentially in certain African countries, and maybe Russia as well. But what do you think?
Yeah, I think so. And, I think it's frankly inevitable. If you look at that cycle that I talked about, that trend that I talked about of ever easier money, ever cheaper fiat currencies, at some point, we're going to see a crisis where the central bank response is so extraordinary, so out of the realm of common sense, because they have to do more than they did the last time to have the same effect. The patient has become addicted to the drug, so you have to give a greater dosage. So we saw in COVID, they did everything they did after the great financial crisis 4 or 5 times over. And the next crisis, they're going to have to do ever more. And then there's going to be another crisis that they themselves engender that they're going to have to do even more. So through this process, fiat currencies lose credibility. The way to instantly regain that credibility is to attach those currencies to something that acts as a governor on the government's ability to constantly create new currency units. That obviously is gold and has been throughout human history. But there are ways to do it without limiting the government. See, the governments don't want to give up control, but if you just made gold and silver immune from taxation, if you took all of that friction away and made them usable in exchange for debts or services, have them usable as currency, they could operate alongside the fiat currency, and the governments could do whatever they want with the fiat currency. But people would be protected because they could own gold and transact in it if they wanted to, although they would not. They would use the cheaper alternative. But they would still be able to protect themselves from the depreciation of the fiat currency.
No, it's certainly optimistic.
Instead of having the government set an exchange rate from the dollar to gold, and this is what gold is valued at, the exchange rate would be set by the markets every day. And so you would hold that, and it would be a barometer on, the world's view of that currency. But still, it would be valued, the currency would be valued or devalued every day in relation to gold.
Yeah, no, it's very interesting. It's certainly an optimistic note I think we'll end on, Brien. Thanks for coming on the show. Please let us know where we can find you, and I guess can stay in touch with your work.
Yeah, you can find me at goldnewsletter.com, and you can learn all about the New Orleans Investment Conference this fall, November 20th to 23rd. That is, you can find everything you need to know about that at neworleansconference.com. And I really encourage people to take a look at that and look at our speaker roster. It really is extraordinary.